Good afternoon, good evening, everyone. Welcome to the Options Animal Annual Review for 2018. And I'll be honest, I would have been a little more comfortable doing this review a couple days ago than I am today. My confidence is shaken today in my bearishness, but we'll get to that. Before we do, it is a pleasure to be with all of you, but mostly it's a pleasure for me that I get to talk in the same forum with some of the brightest people I know. Definitely some of the brightest people in the market. Jeff, Charan, Karen, Horace, Eric, we're all here, and I'm excited for today's show. So before we get into it, I need to remind everyone the information in today's broadcast is for educational and illustrative purposes only. No way a recommendation to buy or sell any security, nor should be considered any type of investment advice. Remember, the stock and options market do involve risk, and you should have a firm understanding of your rights, your risks, your obligations, your exit points, your margin requirements, and everything associated with secondary exit points right now, because it's very likely they are going to trigger, and sometimes trigger multiple times within a week, both to the upside and downside, as you know, illustrated with my latest trade on Facebook this week. But sorry, I digress already. It's early. This is going to be a long show, guys. I'm excited. I'm really excited about talking to you about what happened this year. We had, if you look at it from the big picture standpoint, 2018, our long-awaited pullback. The pullback that we've been talking about was supposed to happen a while ago, and when the markets went straight up in 2017 and parts of 2016 and 2015, and arguably you could even go clear back to 2011. And there's a lot of things that caused this long-awaited pullback. And of course, with that pullback has come volatility. But whether it's tariffs or peak earnings growth or the Federal Reserve, a shift from globalism to nationalism, these are some of just the bullet points. But I'd love to dive into and get some of your take individually as some of the key stories you saw in 2018 as to what drove the market, and whether or not that story is done, or whether it's something that we have to look into continuing to influence the market in 2019. So Jeff, I'm going to start with you. Give me your thoughts on 2018, what happened, and with the sell-off that we had this year, and is it something that's, the major storylines that you saw drive the market in 2018, is it going to continue?
So I think that the major forces that impacted the markets was a shift based on a realization that the tariffs were not going to go away, and that they were going to have an economic impact on corporations, which we've already started to see. And ultimately, that will boil down to the consumer. And as Apple kind of pointed out recently, we are starting to see some of that too. So I think that we were on a course that was headed towards tightening from the Federal Reserve and liquidation of some of the assets that they had on the balance sheets. Those forces were going to be they were going to quiet things down, calm down the economy, slow it down, put some downward forces on it. And then I think that the tariffs coming alongside that also accelerated that. And so what we saw was, when it was a realization, I think, starting back in August and September, that this tariff war was not going to let up, that neither side seems willing to blink. It had gone on long enough, and the tariffs were going deep enough and affecting enough companies and corporations throughout the world, that the stock market started to say this is going to have an impact on earnings. And we have seen that, and we have seen many chief financial officers, CEOs, whoever wants to speak up at investors conference calls, come out and say as much. So I think that's the forces that we're seeing. That was, if I had to narrow it down to two things, it would be the Federal Reserve and the tariffs. And yes, I think it's likely to continue into 2019. I don't think that we have a lot further to go as far as looking at the bottom in all this, but I think that the volatility is going to continue to be a significant factor as we move forward. So I don't want to take it all up. So let's see, who's next, senior? Well, I guess Eric, or well, actually Charan. Charan, you would be next, senior. Your thoughts?
Well, not in wisdom or age, but yeah, so tariffs, right? Last year at this point, we didn't know that there was going to be a trade war. There were rumors. In March, it began. Washing machines, then solar panels, then steel, then aluminum, then 10% of half of what we import with threats to. That's all new. The things that we were worried about in January, where the market sold off, that didn't happen. Wage growth didn't get out of control. Inflation didn't get out of control. Fed, I mean, I don't think they got out of control. They did what they said they were going to do. So really what is different is the China, the Canadian and Mexican, the European trade war. And, you know, on the ground, that is really what shifted, right? Because everything else is good. Economy, all 4 quarters, good GDP growth, good job growth, mostly, I mean, phenomenal earnings growth on the back of the tax cuts that were passed a year ago. But again, I think part of it, the reaction may have been a little extreme here because in the last quarter, that is because everybody recognizes this party ain't going to go forever. And so we're a little bit more finicky and a little bit more watchful. And the Fed has meaningfully raised interest rates compared to last year. And I think starting next summer, or this summer, maybe in the fall, they'll probably raise again. At least once this year, I think it's likely, unless we see signs of recession. All those things are problematic because, you know, trade wars and Fed, these are the kinds of things that can hasten a recession. And we're already concerned about how long this is going to last. And I think that kind of compounded maybe increased the velocity of the move here in the last quarter. Everybody wondering, are we in the 7th or the 9th innings? But trade war, to me, number one, is really what changed. The Fed didn't really change. What we said a year ago is what they did during the year. And then we're begging them to back off, which looks like they are now a little bit, at least in Fed speak. We'll see if that follows in Fed action. Who's next, Eric?
Well, I guess in seniority, but you know, it may be in age, but I would argue wisdom and definitely not looks, because you're much better looking than I am.
I'm glad I muted myself. I just coughed in my mouth when you said that.
You just spit your water out or something?
Wait, between Elon Musk and me, who would you pick?
I'd have Elon Musk's babies.
I'm glad we had that on recording.
Yeah. Holy crap, look who's in the chat. Stanley Winderman, we haven't seen you in forever. Glad to hear you back. Oh man, I missed that guy. Hey, welcome everybody for this end of the year show. So, you know, what I was really keeping an eye on, and this is something I've been watching for a while, is the length of bull markets. So we've had 6 bull markets since World War II. And the longest one went for exactly 9 years and 7 months, and that one ended with a 476% gain, and that's the one that started in 1990 and 2000, 10 years approximately. And so this bull market they end on a high note. So once we get a 20% reset on the S&P 500, we'll say that this S&P 500 market ended, and we'll call the top here, which happens to be exactly the same length as the previous bull market. So be interesting to see if we do ultimately. We've come down to about 19 points, not quite 20. And I think, you know, the way depends on who defines. It's really an arbitrary thing. What's a bull market? What's a bear market? But I just thought it was kind of weird that I hadn't heard anybody else say that this duration would be exactly the same. And that maybe there's some technical traders that will help me understand that a little bit better. But certainly the question is whether or not this bull market is, you know, are we going to see an end here? We've been within a day easily trading of what I would call the end of the bull market, but we've been able to pull up and turn around. So the market is doing better. You know, lately, this was on a monthly chart. But the one thing that I think was a big theme, and let me skip a few slides. This is an S&P 500 chart for 5 years. And what I wanted to point out is this thing on the bottom, which is the average true range. This is a thing that we look at for being able to measure the volatility. It looks at highs to highs or highs to lows or lows to highs to look at the intraday movements to really give us a true measurement of actual volatility. And the theme for me for 2018, there's no question whatsoever, the theme is volatility. This epic level of volatility that came back, and I remember this period of time, in the beginning of 18, just wondering what the heck was going on, because that was really quite an epic move up. And then just as volatile, or actually a little more volatile move probably in the down direction, but certainly just a huge change in volatility. Now, I don't have the data to prove it, but I do believe that this was somehow related to some of the VIX ETNs that no longer exist. I think that during this period of time when we saw no volatility, there was a subsequent rise in people who were trading these VIX-related indices or derivatives, if you will, to hedge a portfolio. And I'll share, because I've had some questions about it. I do not think it's suitable for retail traders. I think you need at least a few $1 million to be able to hedge in a portfolio using the VIX type derivatives. I don't think it's that difficult to understand. It's not that complicated a math actually to figure it out. You don't quite need a PhD, but you do need a lot of capital. I think you need a few million to be able to develop a hedging strategy that could work. And by the way, it doesn't exist anymore because the XIV disappeared and imploded overnight. So I think that was what was going on. I think, this is the year of volatility. The question is, it's back, and it's been back higher than it's been in, the volatility that we're seeing now is, the last time I remember this was 2008. And it's the volatility that I'm talking about, not necessarily the direction of the market. And I'm leaning a little bit more towards, certainly the concern about the end of the bull market. Is this the end of the bull market? But when I look at the broader term, looking at the broader fundamentals, I still contend that the market is healthy. There's concerns for an aging bull market, but just because bull market is old doesn't mean that it should end. There are economic cycles that do happen, and I do recognize that. But I think the economic indicators that I look at are still not telling me a recession is going to happen in 2019. Now, things could accelerate, and we could get one. And what I happen to be in the camp of is what we're seeing here is, as Karen said, the rise of the robot, the rise of the machine. Karen was talking about that she sent me a note ahead of time that we've seen a lot of automated trading, and I think that's what's really driving the market a lot. And the short-term high-frequency trading that traders are out there, they don't care which direction the equity goes. They just need it to move, and so there's no bias, which I think happens to spell opportunity for those people that are willing to be a little bit more patient. Anyways, that's what I saw. I think the big theme for me, like I said, rise of the robots and return of volatility. How about you, Karen? You're number one in looks by far. So.
Well, I suppose being the only female on the panel, it's, competition is maybe not that stiff. I don't know. But thank you. I will take that. Hello, everybody. Good to be with you. I'm so glad we were able to all get together for this show today, by the way. I agree. I was going to talk about volatility, but you did such an excellent job that I will move on to something else, which to me is the Fed. It's actually Jerome Powell. So, we have to remember that he took over at the Fed November 2017. The first time we really heard from him was in the early part of the year. And I remember watching him, listening to him, and something became very clear to me at that time. And that was, I got the sense that he wasn't going to be the same placater to the market that his predecessor was. Janet Yellen, and I'm not criticizing her, but she would walk that fine line. She knew how to thread the needle. She knew how to give the language that would sort of keep stability in the market. Remember, she started the process of raising interest rates. It wasn't Jerome that started this. You know, he inherited already a tightening cycle. But the thing that was evident to me from the get-go with him was that he was not going to be that same sort of, I'm going to assuage, everything's going to be okay, and that type of thing. Now, he did exactly what he said he was going to do, no more, no less. But as the year progressed, it became evident that while we aren't seeing, at least in the headline numbers, the kind of inflation one might expect by this point, obviously in this long bull market, in this long economic cycle, expansion levels, GDP levels, employment levels, everything firing well on all cylinders, and yet not seeing the same kind of inflation that we've seen in past cycles. So, you know, I think the market really wanted for him to continue that path of very, very slow interest rate hikes and slow pace. And when we listen to what he said, and in particular October 3rd, I mean, that's really when the aggressive selling that turned into almost the bear market by Christmas Eve started, when he said that the Fed was further from that neutral rate than perhaps what had been indicated. And that's when, whether it be the machines, whether it be the redemptions, humans or not, that's when it all started. I do contend that he will continue, by the way, to be a theme. We saw it today. We came in, we had a great, amazing, I had to you know, double read the print for the jobs number, which I'm sure we'll talk about later. But very, very strong. And we were going to have a good day, I think, anyway, in the markets. But as soon as we got the message from him, where he basically walked back what he said not even a month ago, which really led a lot of the true hard selling pressure that came in for the last 2 weeks of the year. When he started walking that back today, immediately the machines kicked in once again, and we got the quote unquote rip your face off rally that a lot of bear market rallies are sort of known for. I mean, this is pretty typical, whether it's short covering that starts it, new money at the beginning of the year moving in, combination of all of the above. I believe the Fed and what they do or don't do, and not just that, but what the market prices in, what the market expects. Because now what my fear is that the market showed him and he backed down. And now I'm afraid that the market, you know, we're going to have this tug of war during 2019 between the two. And I think that that's going to lead to continued volatility for quite some time in these markets. So I thought he was a really big player in what happened in this past year. Horace, I think you're the last one up, buddy. You're the newest on staff, so to speak. So take her over.
Yeah, no, and you guys have covered it all very well. I agree. I think that with one note, you know, I agree that the tariffs, in my mind, it is the tariffs that are driving us down this fall. And I think it's worse than it seems, because we got this huge corporate tax cut. And the idea was that we would see a lot of CapEx, see a lot of investment. And then this whole new element of uncertainty was introduced in the form of tariffs. And I think it's very hard to allocate resources to growth if you don't know whether or not you're going to be paying a tariff or how they're going to affect your business. And I think that has really compounded the situation. I think the resolution to the tariff dispute is what is going to drive us higher if we get one. So I think it's not just a question of the tariffs, it's also that they kind of sucked the air essentially out of those tax breaks. And I feel like the guy who said, you know, I went to Southern California, all I got is this t-shirt. You know, all we got is the debt, an increase in the national debt. We didn't see CapEx. We saw some stock buybacks, but it hasn't worked the way it was advertised. And I think part of that is because of the uncertainty that the tariffs introduced. And then, you know, the other point is we've never done this before. This quantitative tightening, this rolling off the Fed balance sheet, it's new to everybody. It's never been done. So I think it introduces another element of uncertainty because the market doesn't know what they're coping with. And when you combine that with other things that are causing people unease, I'm not surprised that volatility has come back. And I definitely think it's here to stay. My view is that this market isn't done despite its age, that there's one more ridiculous run to the upside, and then I literally bar the door because I don't see this ending well, but I don't see it ending soon either. So that's my take on it really briefly. I'll throw it back to you, Greg.
Well, on that note, just as you know, I know it seems like today, and I know some of these, if you look at the chart, folks, we're still in a confirmed downtrend. I know today felt really good. If you were long the market, or if you haven't covered your, if you're still hoping that this thing is done, but this is not how markets act at bottoms either. Just so you know, I've seen the market bottom several times over the last 25 years, and this isn't how they act at the bottom. This is still part of the sell-off. From a stat standpoint, the top 12 sessions for the S&P 500 of all time have all happened in bear markets. So one-day sessions. 21 of the best 25 days were also in confirmed bear markets. The other 4 were all in 10% plus correction. So don't hang your hat on today being it's over. Now, does that mean that it couldn't still recover and it might not be the bottom? Sure, it might. It might be okay. There are a lot of things hanging on it, and I think both Charan and Hort, you guys all mentioned it, but I believe the one thing that we could see that could stop the bleeding in this market is a resolution with China. It really is causing a big issue, and it was interesting yesterday, and I've traded Apple for a lot of years, and the biggest thing that came from me yesterday was, why did Apple warn? Apple doesn't warn, folks. Even when they're going to miss on earnings, they don't warn. That's not who they are. They've never been a company that warns in the middle of a quarter. They usually wait until you have the conference call. And that warning yesterday from Apple, to me, may have been more than just Apple. There may have been politics behind this. We have a lot of things going into 2019 that are really uncertain. One of them being a split Congress, that the new House of Representatives, their first agenda is to go through the impeachment process. Now, it'll die in the Senate, but it's going to cause turmoil. We're going to see more political turmoil continue to draw into this, and the real question will be is how much political pressure will go on President Trump to do, in my opinion, the one thing that can help this market from continuing to slide, and that is to come to a resolution about these tariffs. Now, let me also take a step back too. In the short term, I believe this is overdone. The economy, let's not throw the baby out with the bathwater. And by the baby, I mean actually the big baby, in that the economy, I mean, we got good news today, right? We got good data as far as employment goes. I don't think the US and world economy is 100% broken yet. And I say yet because sometimes market volatility, if we get too much market volatility, it can spill over and break the economy. I don't think we're there yet because, again, we're only down 20% from our highs. Yeah, that's the S&P. Some people may say, well, Apple's down a lot more than 20%, or Nvidia's down, over 50% from its highs. I mean, there are some individual stocks that have been absolutely crushed, but the economy itself is still doing okay. And so I don't want to jump out and say, I guarantee there's a recession, I guarantee there's a bearish market, but there's a few things that have to happen, because one thing that I do not believe that I heard today, I do not believe a word that came out of Chairman Powell's mouth. They are going to raise rates next year, and they're going to continue their unwind. I do not see that changing because they don't look at day-to-day swings of the market to help determine their thing. If anything happened, why we got the one in December in the midst of the bearish decline, is that one was also political driven, more so than what the markets want, the S&P anyway. So I think there's still, what I believe is going to stick around, and in 2019 that I saw as the big story, in 2018 as well, is we're going to continue to see volatility. That is not going away. and maybe for a couple of years, because right after 2019, we start another presidential cycle election that I'm sure will be a reality show in and of itself. Okay, Jeff?
Yes? Hey,
How'd
I
we
have a
do
question.
last year?
How'd we do last year? We did pretty darn good last year. What do you mean, how'd we do?
No, I mean as far as predictions go.
Oh no.
I don't know if Eric has those. Oh,
He does.
apparently we do. I don't think I did so good.
On individual stocks, I don't know if any of us did very well. I would have done a little better if we wouldn't have had that rally between Christmas Eve and
Greg,
New
you
Year's.
nailed it.
I came really close.
Yeah.
I guess I should resign, huh?
Shut up.
Yeah.
Well,
No.
if anybody trades based on what we're saying here, then those people should resign from trading.
Yeah, because I'm pretty sure if you were to flip-flop this the other year, it was the exact opposite. As I completely missed it, and I'm pretty sure you nailed it, Jeff.
Yeah. No. It goes back and forth. You know, it's just we can't see the future, and who knew that Trump was going to spoil the party by wanting to get into a blanking contest with China over the tariffs. I mean, I know he's making good on political promises that he made during the campaigns, but it really is not a very intelligent thing to do if you're trying to keep an economy going strong. What, Eric? What?
If you made a very bullish prediction at the beginning of January, you looked like a genius. You would have said, "Oh, geez, we're going to hit 5,000 or something crazy." The rate that we were going up in January, that was parabolic. It was just absolutely crazy. And to get another 300 point move from the end of January, the end of the year, that's not unrealistic. I mean, it could happen, and you could see it happen. So, I mean, these are just kind of swags, and we take it with good humor. But just to see where we are. But it does scare me how Greg was like, "Holy macadoli!" He missed it by a week because he was right there.
Hey, Greg, while I'm unmuted, I don't understand what you meant or how the warning by Apple was politically driven. I didn't quite understand that, and if I didn't, I'm sure there's some other folks who didn't either. How was that politically driven?
All right. I'll go into a little more detail.
If you wouldn't mind.
In my opinion, it is no secret that Tim Cook does not like Donald Trump. It's not a secret at all. If you follow either one of them, they do not like each other. Unfortunately for both Donald Trump and Tim Cook is the largest company in the United States, and Donald Trump is the president of the United States.
Not anymore.
That's true. Impeachment is going to happen, right?
No. Cook.
Oh, Cook is not the largest company, though.
No, they're now fourth.
That's true. That's
Sorry,
true.
Didn't mean to interrupt.
After the sell-off, so I believe that Apple was making a statement. I would not be surprised to even potentially have that there may have been a conversation, a phone call from Tim Cook to Warren Buffett that said, "Warren, we're going to tank our stock, but I'm making a political statement right now about how bad this tariff is doing damage to the economy."
That makes perfect sense.
We're gonna warn on China.
Okay, that makes sense.
Because if you look at the rest of the conversation with Apple, they're going to hit record numbers here in the U.S. on phone sales. They're hitting record numbers in a lot of different countries. It's really only China that is causing the issues with Apple having to warn. And again, with Apple never having warned in the past, why now? And why did it happen the day after the new Congress was sworn in? Why didn't they wait until 2 weeks before earnings? I don't know.
I want to jump in really quick. Did you see there was an economic advisor, I forget his name, Hastert, I believe, who came out to the lawn and said, yeah, and it's not just Apple. It's going to affect a whole bunch of companies, which I thought was just bizarre. So I don't know. Who knows? You might be right. It's certainly true that they don't like each other. And the other thing that confused me, Greg, is that, you know, in the conference call, Cook explicitly called out China for no weakness. It was very clear 5 weeks ago. So something must have happened fast, or you're absolutely right. Anyway.
I appreciate you clearing that up now. It makes sense.
There's something going on with China, the White House, and Apple, and I don't know what it is. And there was a headline just earlier this morning. I just popped it up there with Kudlow saying that there may be some shenanigans going on, talking about Apple technology being picked off by China. So I don't know that they hate each other. I don't know what's going on. I think there's something going on with Apple, and there's back and forth, and Trump makes comments about not caring and saying that they need to move manufacturing back to the U.S. And I'm sure Cook's smart enough to do what needs to be done there. So I mean, this move with Apple did shock me dramatically that Apple's going to drop 10% based on a 1 quarter revenue adjustment of it was about an 8% adjustment of revenue, but that's not 8% in profit. So the company's still going to be profitable. It's not going to. I don't think it was warranted, the move that happened. I mean, I think Apple's a tremendous value right now. If you're looking at it from different fundamental indicators, it's even if you lower your forecast, it's still a pretty good value, I think. And I don't know if you saw Gene Munster's. I mean, he's still saying Apple within 3 years will be $3.50 a share. And I don't know that
I think I agree with you, Eric. I think this is way overdone on Apple. I think there's a couple of manipulations going on, and of course, Goldman Sachs, I believe, just came out with it's only like 3 days into 2019, and Goldman Sachs already, in my opinion, has the absolute worst statement of the year. I don't think it can be topped when they compared Apple to Nokia.
Yeah, that was good.
I mean, I'm old enough to remember Nokia in its heyday. I made a lot of money trading Nokia back in the 90s. And I'm sorry, these are not even close to the same types of companies. From a cash flow standpoint, from a cash hoard standpoint, and from a diversity standpoint, Nokia was and still only is ever been a cell phone maker. That's it. Apple had what, $10.5 billion last quarter or last year in their last quarterly report in just their services revenue. So I don't know.
Well,
I'm ready to short Goldman Sachs over it. It's what I am.
So I'll go back. I have other slides, but you brought up how we did, and so these were our stocks to watch for last year. Here's the performance of how we did for the S&P 500, and then I looked if you had a portfolio of $10,000 and you split it evenly with each one of these shares that the three of us picked. The winner was Karen, as far as the portfolio goes. She did outstandingly well.
Well, how about that?
Yeah, no surprise. Not at all. No kidding. So, Horace, you want to talk about?
I mean, you'd be hard pressed to do worse on purpose than the two stocks I picked. In fact, I'm tempted just to pick them again because chances are, no comment.
Yeah, well, I was when you and Char are both 1749. I wasn't on the show last week, last year, because at this time last year I had something else going on. I wasn't able to make it. But yeah, yeah. So, anyways, that's the result. This is and I have to point it out because I know you folks know we don't make money with a stock just going bullish. If all we were trying to do was pick stocks that would go up, we wouldn't have jobs. And we make money in any direction. So, and that's the reason why we collar trade and do what we do. So this is just for fun and a little bit of razzing between coaches and directors.
So in a sense, I won because my stocks moved the most.
Yeah, you did. You probably did. You had the most volatility.
I have. There you go. All
right. Okay. All right. So did you want to talk about, I guess, I don't know, where I had a few other slides on just looking at the overall charts for different stocks. I don't know if you wanted to look at any of the different, not stocks, but different indices. And
I thought it was interesting, and maybe you've got if you go right there to the NASDAQ. I think another story that we saw in this last year was also a kind of a breakdown, or maybe I should say a separation in the performance of the FANG stocks as well. And I know that's not necessarily represented 100% by the NASDAQ 100, but they're all big components in that. And what I mean by that is you had, big sell-offs in some of the key components of FANGs, particularly Facebook, and then later in the year in Apple. Big sell. And Facebook actually happened much earlier. Facebook declined early in the year, and in fact, to be honest, Facebook's kind of held up somewhat in the sell-off that has happened in December. That's really plagued Apple and Netflix. But you've seen kind of a split because Amazon has kind of risen above, and they've of course still sold off because the whole market has sold off and they're well off their highs. But I think Amazon may have actually separated themselves a little bit from FANG, as I believe has also Netflix, also kind of separated themselves and still kind of moved above. But you've seen the likes of Facebook and Apple and NVIDIA and Google really get hit hard to the downside this last calendar year. And it will be interesting to see as we go into next year if that separation continues. NVIDIA's just got to be one of the most horrific stories of the since October. I mean, they were at $292 a share the first week of October, and they hit 120 last week. Just been an absolutely chaotic ride to the downside with NVIDIA over the last, and their earnings report, by the way, that miss and that guidance lower is, I also believe, one of the other major reasons why one of the main things the market's got to overcome in the next couple of quarters are some of these big misses by some of these high-flying tech stocks that everyone loved in 2016 and 2017 that have come crashing back down to earth again. So that to me was another interesting story from last year. Was the FANG stocks losing the lead that had led the market. What about the VIX? Is volatility here? I mean, we've kind of all said the volatility is here to stay, but what are your thoughts on that, Eric?
We are definitely in a new trading regime since October, and it's seen, not only in the pullback in all the major indices, but as well as the VIX. And we've been in this reversion where we've had the VIX higher than the futures basically for the whole period of time. It is comforting to see that the VIX futures are not dramatically higher. If the VIX futures were 24, 26, 28, people would be jumping off of buildings and stuff. So this is the VIX, spot VIX, and we're seeing the VIX come down quite a bit. I don't know that we're going to see the VIX down in the the sub 10 range like we saw last year. But I would expect to see the VIX down in the the 15 to 12 range. That it could take a while for it to work out. I think a good portion of what we're seeing right now, like I said, is the automated trading, not necessarily. The VIX tends to respond to what happened in the market. And that's not what it's designed to do. And I think because it's traded, it's lost its value. But I expect that the VIX is going to drop back down. Also, looking at the fear index, we had the lowest reading that I'd ever seen. I think it was a 4 that we saw a few weeks ago, or a week or so ago, was the lowest that I've ever seen on the fear and greed index. So we had that very, very low point, which those are usually opportunities because we don't usually stay low for a long period of time. we see the VIX drop back down, and that this fear index will a few more good bullish moves. I think we can get back up there. Like I said, I'm not in the camp of we might get a bear market, but I'm not. I don't think we're at a recession. I don't think it's economic yet. I don't think we're there economically. That's my thoughts. What about Jeff? Do you have any? Go on. No, go on.
No, I want to go to Jeff next, but I want to switch markets because I think another important thing to look at, and I want Charan's take on this too, because I know Charan, you trade this, and Karen, I believe you do as well. But I want to talk about oil. Oil to me, and I'll give you my feeling on backstory on oil. Oil to me, I don't trade it very often. I do once in a while when it gets down at low levels, which is kind of where it's at right now. So I might actually start picking some oil up again, but this has been a pretty dramatic drop in oil in the last 3 to 4 months. And I know we've seen drops like this before. Obviously, the drop you can see there on that chart in 2014. I remember a big drop in 2008, in 2007, that was part of the crisis, the financial crisis. And sometimes the demand for oil is a reflection of the global economy. So, Jeff, I know you trade oil a lot, and then Charan, I'd love to get your thoughts as well, and Karen also, because I know you trade oil as well. So, Jeff, I'll give it to you first. Is oil found a bottom yet, or is there more pain?
Well, I think there could be some more pain. I think that under the current administration, there's a lot of support for everybody here in the United States that is involved with the production of oil to drill, baby, drill, and to get as much out. I mean, we're net exporting now at this point, and I don't see that letting up. And without the cooperation of all of the OPEC members and some of the non-OPEC members that are also high in production, without any sort of concerted effort where they all decide to limit production, I think oil is going to stay down. Eric had called a long time ago for oil to go down. I think you were talking like $25 a barrel, and I had maintained for a long time the $60 to $75 a barrel, and I think that's finally over, and that this is probably a little bit lower than it should be. I don't necessarily think that it's found a bottom, and that next week we start trending higher, but as we are developing technologically, we are reducing our dependency upon oil, and that is going to continue to grow throughout the world. It's inevitable. At some point, we're going to be looking at electric cars, and we're probably going to be looking at driverless cars for the most part. And so that's a huge shift. And I'm not sure whether or not cars are the largest single element that consumes petroleum. I wouldn't be surprised if they are. But I don't see us going back up over $100 a barrel. I mean, we may have some issues along the way where we temporarily spike back up towards the $75 mark, but in the long term, I think oil is going to probably stay lower. Charan, how about you?
It's really hard to say. It's a commodity. It moves fast, and that's what we learned again. And previously, when it bottomed out, that was almost exactly just over 2 years ago, beginning of 2016, it bottomed out. 3 years ago, I guess. And so last couple of years, like when it got down to the low 40s for West Texas, it started to move back up. Like in the low 40s, 40, 41, 42 is where support has been. It got there last week, and I think it's quite likely that oil gets back at least into the 50s. I feel more sure about that. It's likely to move up. That demand is not that bad. That supply issues, we already see rig counts maybe stalling a bit. I see that more likely than 30s. 50s more likely than 30s, and that's both fundamentally and technically. One of the things that could really hasten, the rise back, maybe not back to the $75 level, but like 50s, is if the dollar, which is near resistance of the last 3-4 years, if the dollar starts to come down, then we have a trade deal with China. Watch how quickly this thing will unwind. Or we have stability in the market and the VIX drops. I think safe havens like dollar may unwind as well. Or if we have better economic growth in Japan or Europe or China, dollar will start to unwind. So if that happens, I think oil, I feel a lot certain then that it'll get into the 50s, 60s. And that's a pretty good place for a lot of companies in that space to operate very profitably. Karen?
Yeah, I agree entirely with your forecast. And I actually think that, sort of a reversion to the mean trade, a lot of equities in this space. We talk a lot about technology and apples and fangs and things of this nature, but if you take a look at this space, there's a lot of companies that have really been decimated in this oil sell-off. So just a reversion to the mean kind of trade, depending upon what your expectation is for 2019 already, you could kind of see, we talked a lot at the end of the year about redemption requests and things of that nature, and I trade Schlumberger, and that's my absolute worst trade. Thank goodness it wasn't one of my three, because I definitely wouldn't have been in the lead had that been the case. Fortunately, we know how to call our trade, but you could just see day after day after day that equity just continued to fall. And then once the redemptions kind of stopped, once the tax loss selling most likely stopped, it just kind of stagnated, and it's done nothing but move to the upside so far this year. And I think that that's a function of what's been terribly oversold, maybe some of the leaders to the upside, at least for a period of time. I think your forecast in the 50s makes a lot of sense. It is a very different supply-demand equation than we've ever had in terms of our own production. And as Jeff said, being exporters, who ever thought that would be the case, several decades ago. So there's always going to be volatility in this space. There's lots of speculation in oil always, but there could be some interesting reversion kind of trades for this next year. Greg, back to you.
Horace and Eric, I didn't mean to, not include you in the conversation on oil. If you have something you guys want to add to it, I just knew these supposed to be traded.
I'm good.
No, me too.
Okay. Anything else major that we need to talk about from things that happened last year before we start looking into next year?
I gained 6 pounds.
What? You're too skinny anyway. You needed to gain some weight.
And I consumed a lot of bourbon in the fourth quarter.
Wow.
You gained 26 pounds, Kevin?
No. 6.
6.
6. Oh, okay.
26. That would be a
All right, 6 is okay.
big percentage move.
If you drank beer, you'd gain more.
Yeah, can't do it. Not efficient.
No,
Bourbon
it's not. Yes, understood.
Efficiency. That's what I like about you guys.
Others just highlights, just showing the overall sector performance, and that everything sort of trended together for the whole year. Not that there's anything in particular, but I think it's a good idea to look for sector, because sector rotation is a real thing. It does happen. We're seeing consumer discretionary and utilities. I keep some of those on my watch list, and it's interesting that when the market does really bad or does really poorly, those two sectors tend to do a little bit better, which does show that there are people that are managing their portfolios for that sector rotation, wondering if that's, if we're getting to this long-term recession, that those are places where we'll see money go. The other thing, the yield curve, we talk about the yield curve. We did get some recovery, and this is the 10-year and the 2-year. The 3-month actually looks pretty scary, but the 10-year and the 2-year, we'll look at that for now. I know where this is the longer-term chart down here, and that's heading up. The other index that I like to look at, this is a 5-year chart looking at the U.S. dollar, the strength of the dollar. We've seen economic woes that have happened on both directions, with the dollar getting too strong or too weak. And right now, I think it's pretty Goldilocks. Actually, seeing the dollar went down. This is a month. These are monthly bars, so you don't really see it. But I do think part of the strength that we saw is the strength in the dollar weakening. We generally want to see a weaker dollar. It makes our products more attractive. And this is, for me, for themes that I look at, these are the broader themes going forward. The other is the S&P 500 PE ratio, and I know this is a couple different places. I'm not 100% sure this is the right one, but it does trend in the right direction. But we are seeing what I think is a very encouraging thing, and that is a strengthening of the PE ratio. Meaning that there's, at some point when this gets too low, there's a lot of value, and Apple's like, less than half of that value. So And there's other values that are out there. That's just one of them. We talk a lot about Apple. And just looking at this is the other broad indicator that I like to look at, was the Conference Board leading indicators. I don't know if you wanted to talk about any of the things that are coming up this, what that happened this week, or before we jump to like looking ahead to next week and next year. The non-farm payrolls came out. It was, knocked the cover off the ball, right? I mean, just phenomenal. How many jobs did we add?
A bunch.
312. And every time we say we're at, max employment, we do one of those, and
look at 312. We were forecasting, under 200. It was just an insane number. Well, the good thing that was interesting about, or it is what it is, but good news is good news now. So apparently this is good news. I would have thought that, I wouldn't have been surprised to see with this such a strong number, the market pull back, because this really does kind of force the Fed to play their hand, So, hey, the economy is doing really, really good. So continue to raise rates. We'll see how that plays out. But
that's one of the reasons why I agree with what you just said right there. The Fed is not going to back off if we have strong jobs like that.
Well, not just the jobs, but also the wage growth. I mean, there's no way that the Fed can back off with that. And I agree with you, Eric. It's kind of interesting that the markets didn't interpret this as, oh no, fuel for the fire for the Fed to continue on the program of tightening. And that's exactly what I think it's going to do. But, between yesterday and today, I think a lot of what was yesterday is that Apple is such a core component of all three of the major indices that Apple pulling back 10% triggered all the algos to go crazy. And we saw that huge, what were we down yesterday? 500 and something points?
I think it was over 600.
Yeah, over
That
600.
was over 600.
It was over 6.
Pretty close,
Okay.
pretty close to what we gained back today.
Okay, and then today was the same sort of thing happening, except that a lot of people thought that it was an opportunity to bottom fish, which sort of supports what Kathy was saying in the chats earlier, that this actually, statistics show that there was a lot of retail buying going on today. I mean, I think that the storyline that the economy is still fine, which is true, resonates with most of the investors, and everybody's sort of been looking for a bottom and an opportunity to jump in. And when Apple, through whether it was politically motivated or they have a real issue, made that announcement yesterday that really triggered the massive sell-off that we saw, a lot of people thought this was a nice entry point. And so, we had this big pop today. Whether or not that holds going forward is yet to be seen. And I took off on this off of the fact that we didn't, react to the jobs report and saying, uh-oh, that means the Feds have more reason to raise rates, which they do. So we may see it just go back. I don't think this volatility is gone, and I don't think any of you do either, that we're going to continue to see these wild swings that are in the marketplace. Anyway, I just wanted to throw my 2 cents on that with regards to the employment rate and the Fed.
Well, like I said, the narrative is raising rates are what's really upsetting the market. Why didn't the market react negatively today?
Right.
That's just. So the narrative that it's really about rates, I don't know, because there's other stuff going on too. And so it's not. It makes the picture. It makes my personal argument, that I think it's the robots, which is less. I don't know. That's not a good thing. I'd rather it was the Fed, because the Fed would, if it's the Fed, then you kind of know if you know what they're going to do, you kind of know how to trade it. But you don't know what the robots are going to do. I want to hear. I know that Horace had a lot of thoughts about sort of the Fed and the market and the raising, and wanted to get your thoughts a little bit on this.
I don't have that many, actually, Eric. I mean, other than this is a novel situation. One of the things that worries me about the Fed is that if we go into a recession at these levels, they don't have a lot of ammunition. And I said this years ago, that they're going to start raising so that they can lower it. And I don't know what happens if we enter a recession with rates at these levels. I'm sure they'll come up with other creative financing and backstop. But they're going to be reinventing the wheel again. So from that sense, I think they do want to. I disagree. I watched Powell today. I don't know. They say, Greg, you know more about this, that the markets will test a new Fed chair, and I think that's sort of what we're seeing. I was struck by his presentation today. He had notes. He spoke very clearly, very slowly, and very thoughtfully about kind of walking back some of the autopilot language that we saw at the last press conference. So I'm less inclined to believe, and I kind of feel like they're a poker player who's all in, right? If we get a recession now triggered by, among other things, a steep decline in the stock market, we have a problem in that they don't have a lot of medicine to administer the economy. So I think he's going to be real. I believed him. I think he's going to be very, very wary to cause much more of an upset before, there's no rush to raise these rates. There's no sign of inflation. So I don't know. I'll throw it back to you though. That's basically what I took away from him today. I was, and I'm not sure if he hadn't spoken, we wouldn't have seen a mid-morning reversal. I mean, he came out and started talking around 10:30. A lot of times you'll get a move up in the jobs number and then it sinks in. And around noon, you start to see the selling. I don't know. That was my take today.
I agree. I think the markets rallied today on Chairman's speech. I just don't believe it.
Hey, listen, Karen's going to run. So let's, before she goes, I want to jump ahead and get Karen's prediction on where the S&P 500 is going to be on December 31st, 2019, and what are your 3 stocks to watch for the year?
Okay, thanks. Sorry that I have to leave everybody. I have an appointment this afternoon that I could not change. So the 3 stocks, we'll start there. I have a theme. I always try to come up with a theme for my stocks. And my theme this time is these are 3 companies that in the last earnings season, in the middle of October, when they reported, actually one of them reported more recently than that, they had really great things to say, both about their current quarters at the time, but also upcoming, what their forecasts and their guidance were. And yet all 3 of these equities have sold off amidst the bearishness in the market. And I think all 3 may present an opportunity from that standpoint. So these are going to be 3 different ones than you've heard. Well, one of them you've heard me talk about in the past. The other 2 I don't know that I ever have. So my 3 stocks for the year, the first is Mr. Softy, Microsoft. The second is a consumer play. That's going to be Visa. And the third, and this is one that I've traded off and on for years, not a lot last year, that's going to be Nike. And so these will be my 3. And, as far as the markets, I do think volatility continues. I think we have an opportunity to trade both bullishly at times as well as bearishly at times. I'm going to be slightly optimistic in my year-end forecast, and I'm going to put us at 2750 for the market. And that's pending that we don't go into a true recession, that the market doesn't decide that the Fed is making some sort of big misstep, and that hopefully we will in fact get some resolution sooner rather than later from the tariff situation. If some of those things don't go according to plan, then that forecast is definitely going to be too high. So that's what I think for the next year. Thanks for letting me get that in there, Eric. I appreciate it.
Okay. I'll let you go. We'll get back to what we were talking about.
Sounds good.
Hey, those are the same stocks I was going to pick.
Sorry about that.
No, I'm kidding.
All right. You know what? That's a good transition, though. Let's start talking about what we see, because we're already at the top of the hour, too. So let's start talking about, okay, everything that happened this last year, the volatility, we've all said it's going to continue. What other things do we see in this coming year that could be major stories that are going to drive the market? I still believe the number one thing driving the future of the market right now is the trade war and the tariffs, particularly the tariff battle with China. But it's not just China; it's tariffs in general. They hamper productivity. They hamper economic efficiency on both sides, and that ultimately gets passed on to the consumer. And in a world where the consumer is 75% of the economy, that's going to hurt. So, and if these tariffs don't stop soon, we're going to start seeing this impact the consumer, where they're not going to be willing to go out and spend money and buy those high-end products like Apple phones. So I still think, to me, that's the number one thing looking into next year. But there's a lot of them. Eric, you've put together an exhaustive list here, and I love it. I didn't know you had my name in it too.
Chaos.
The very last one, chaos. Yeah. Right.
Thought it was mayhem.
Oh yeah, I'm mayhem. That's right. I'm not chaos. I'm mayhem. Jeff, what do you think is going to be the major storyline in 2019?
Well, as far as what we can see from what's going on now, it would have to be the same thing that you said: tariffs and its impact, its negative impact on consumption and growth. Other than that, it's typically something unforeseen that comes out on the scene. I am still concerned about a slowing economy, and we'll see whether or not that plays out. Hopefully, it doesn't. I look at the FedEx report and the laying off of thousands of employees, and other companies are starting to do that as well. That concerns me a little bit, but we'll wait and see. I really don't have anything else to add other than that. How about you, Eric?
Well, what I'm really looking forward to is, everything that's going to happen on the right side over here. I'm looking forward to a really contentious deadlock White House and impeachment hearings, actually, and not for the reasons that you would probably think, and that is because let's take the focus off of the impact that the government can have on the markets if we're all spinning our wheels on hearings and all kinds of stuff which I personally don't like. I think it would be better for the markets if the Congress just turns into a crap show. Leave it at that. We'll see what happens. But I don't have a lot of confidence. So personally, I don't think that's a good thing. But for the market standpoint, if everybody in the news just focuses on what's going on in Washington, then let the markets do what they're going to do. And, maybe some of the volatility will settle down and some of the crazy moves will settle down. The other two things that are on here, by the way, I do have to give credit to, Chardon and Horace and Karen did send me some ideas of stuff to put in the show. So I appreciate that. And this came from them. But the debt crisis to me is, I'm on record as saying that I think this is a big, scary unknown that could potentially be, if we're going to have another crisis, it's going to come from debt. Student debt is a problem. Corporate debt is a problem. It has multiple ways of rearing its head, whether it hobbles people and prevents them from, spurring the economy by spending money because they're having to service their debt, and raising interest rate doesn't help that. Or corporations, same thing. If it impacts their profits, then it's going to hurt their valuations and ultimately stock price. So we need to keep a look on the debt crisis and see where that goes. And of course, the chaos came from Horace, and I added the unknown unknowns. And he made a really good point. I'll let him, if he wants to elaborate on that. I'll let Horace take it from here.
Oh, sure. So every administration faces a crisis at some point. It's just what happens. And Jeff, you're absolutely right. I don't think we can predict what it is. I think we're in a position right now where we have we're really at risk, because I personally have absolutely no faith in the people who are in charge, think Treasury, think in the executive branch, to handle a crisis. You may disagree with Tim Geithner and with the people who have handled past crises with Bernanke, but they were people of substance, and I don't see that today. So maybe it's my own lens. I don't think so. So I am very worried that a potential economic crisis or international crisis is going to kind of expose the weakness. It has been chaos. We have such a revolving door in these major positions that who knows really who's in charge. And so I think we run a real risk. And that's what I meant by the chaos in there. It's not a political comment, it's just a fact. People are in and out of jobs so often in this administration. I'm not sure anyone knows who's really running the show. What I have seen from our Secretary of Treasury doesn't inspire confidence. This guy is a movie producer, essentially. So let's hope nothing goes wrong, is really where I wanted to come at it. But Jeff, how about you? Do you want to comment on any of these?
Well, no, just what I started off with. I think it's the unknown that's gonna be the concern.
Yep.
That's all I got.
Sharon, how about you?
Yeah, some of the things I think, the U.S. 10-year, which has come back down dramatically, I think that rises in 2019, and there'll be Again, we'll be talking about how interest rates are going up. I think if the economy does not sink into a recession and, we hold on, we have maybe 2.5% type growth, why wouldn't that happen with labor market as tight as it is? Another thing I'll be watching for, I think we're going to see the conclusion of the Mueller report. And again, that goes to government in Washington and what happens as a result of that now that the Democrats control the lower house. Also, I think we'll find out, here's a prediction, we will have earnings growth. It's crazy to go from like 25% to zero, even though the market seems to be pricing a disaster. I think we're going to find out that we actually do have earnings growth in 2019. And the last thing I'll be watching for is what happens with the emerging market world. I'm interested in that in the currency sense because currencies are at like decade or more lows. But also valuations are, from what I've read, much more attractive overseas than they have been, at least till September. That was certainly the case. And I think even now, even from a diversification point of view. So that's another thing I'll be exploring in 2019.
Okay. Anybody else? Anything to throw on before we jump to our favorite little prediction section of the market?
We did have announcements, but we'll put that afterwards. So we're going to go in order of seniority, boss.
I'm going to go the opposite. I'm going to have Horace go first.
Oh, great. Okay. 2100. But I think we're going to make a new high before we go down. How about that? And then my three stocks, I really should just pick the same stocks because how could they go any lower? But I'm going to, Micron is going to be one of them, MU, Bud, Anheuser-Busch. And then finally, I think I actually will, I don't know. This is a tough one. No, not Tilray. No, I'm not going to do it. Maybe Bitcoin. No, the third one, I'm going to say Facebook. I bet they throw Sharon Sandberg under the bus and we all forget this happened by the end of the year. So those are my three.
All righty. Well, starting from the bottom, I guess that's next one's me. 3,200.
Ooh.
Apple, Micron, and one I don't usually talk about, and that is Disney. Apple, I think it's a tremendous value. Micron, a 2. I happen to think, and I mean, don't trade your own trades, do your own due diligence, have your own secondary exits. But I happen to feel on these two equities that, when I look back at 2009, March 2009, and I look at the bottom of the 666 and the S&P 500 and so many equities and say, man, why the heck didn't I buy then? I just, feel that way about Micron and Disney right now, and Apple right now. And I could be wrong, and I probably am wrong, but that's why I have secondary exit plans. But I'm going to go with a bullish case just because I think there's so many bears that are out there. I'll be the contrarian. I'm not opposed to taking that view. So that's it for me. How about you, Charlie?
Okay, my target is 3,000. I thought we would get there this year, and now I think we'll get there next year. I made that prediction, and within weeks the market was almost there in January. So maybe it'll be. We'll see. We'll see how it goes. So my stocks are AMAT. Applied Materials, that's AMAT. This one's trading at like a 7. I'm really liking stocks that are single-digit PEs, price to earning multiples. This one's also got a 0.4 PEG, and for a tech stock, it's not bad. It pays a dividend. My second one is TPR. That's Tapestry, the owners of Coach and Kate Spade. Again, single-digit PE, 4% dividend yield. They're growing about 9-10% a year earnings, so I like that. And my last one is Schlumberger. Man, that whole space, Halliburton, Weatherford, all these stocks are beaten down. 5% dividend, trading at 39. Analyst target price 59.
I wanted to go back and just talk about Disney real quick, and I don't know if hopefully I didn't steal yours, or is it yours, Greg?
Well, I'll be trading it, but it wasn't one I was going to talk about. But I will own. I'm not in it right now, but give me
I think
4 more days, and I will.
There is a tremendous battle on the horizon for streaming, and Disney is not going to do something small. They are going to do something big, and I think they're going to just absolutely put a ripple through the market and that whole space. I wouldn't be surprised if we see some big acquisitions from them, and also, I mean, if you look at the lineup of the content that they have coming up, it's going to be a really good year for people who like Disney products. There's a lot of good movies and other things that are coming out, new theme parks, 2 major expansions. The Star Wars thing is just going to continue to take off. So I just really like Disney. I meant to mention that earlier. So I'm really excited about them for next year.
Could they not just buy Netflix? I mean, I know they're only a little bit larger in market cap, like about 40 billion, but I've seen that happen with companies that are almost co-equals and they merge.
I think you're right. That's a good idea. We should tell them to do that.
Yeah, I don't think they like all the debt that Netflix has.
Yeah, I'll tell Bob and Reed to get together and figure it out this
I was
weekend.
just going to say, do you have Bob's number? We can just give him a call.
I'll reach out to him on Twitter right now.
Were you a Mouseketeer, Eric? Do you have this?
Yeah.
There you go.
El Jefe.
See? So I'm not as bullish as I was last year, and I'm thinking for my S&P number 2,700. So a little bit higher. I think we go lower before we go higher. No, not 200. 2,700. Thank you. As far as my equities go, USO is one of them. I think USO's moved down too far, too fast, and if it rallies back up to 13 or 14, that's a huge return. Apple's on my list. I agree with everything that you said, that this is and what we've talked about. It shouldn't be this low. It's just crazy. And the last one is a surprise. Well, it's something different for me anyway, and that's Echo Tango Foxtrot Charlie. Anybody know that one?
He tried.
Huh?
I got to go do an event with him in a couple weeks.
Yes, you do. Yes, you do. But the thing that I like about E-Trade is that they have had significant growth. Their earnings per share growth over the last 5 years is over 50%, and the forecast is for over 27% annualized for the next. And I think that they're in a position where people like us who can trade the market in any direction will benefit or won't be harmed as much if there is any sort of slowdown in the economy, because people are going to continue to trade, and so they're going to continue to see commissions and nice revenues through that. And I think they're doing a pretty good job, and of course they got Greg and out on the road and helping them. So how could it not work? So the others are pretty obvious, but that's it for me. How about you, boss?
Well, you guys have all mentioned several stocks that I will own. 11, 10. I think we are going to finish the year at 2278.
Ouch.
I do believe that 2100 is where we will bounce. So where Horace says that he's going to end the year, I think we will go hit 2100 on this correction. I believe that's our long-term technical support, where the algos jump in and start to buy it, and we'll see a recovery. We're going to price in the recession that's going to happen. I believe we do see a mild recession at the end of this year, maybe 1 or 2 quarters of recession, at which point I think we pull back out. And I think, some of the strengths that I actually am going to be looking at picking up in this, there's a lot of them. Apple's at the top of my list, but you've already talked about it, Jeff. We've talked about it a lot. Eric, you talked about I will be buying Apple, but let me give you 3 different ones that I think are some interesting plays right now. The first one is Papa Yankee Papa Lima. This is PayPal. This is the future of payments, folks, if you haven't already figured that out. People don't do checks anymore. They're even starting to more and more go away from credit cards. And if you want to send people money, you send it to them via PayPal or Venmo. Well, guess who owns Venmo? PayPal. So I like them. I think, they're expensive, like any tech stock, but they've had a pullback. And I think this is an opportunity to pick up a really good financial related, transactional related type of company. So that's the first one I'm looking at. The next one is I also really like the gaming space. I've traded it for years. I like the fact that a lot of them have pulled back recently. And I don't mean gaming like Las Vegas Sands. I mean like internet gaming, web gaming that a lot of people play. You know, there's the likes of Activision, there's the likes of Electronic Arts. Those are the two popular ones. I'm actually going to throw out that I don't think the move in Fortnite is done. And so I'm actually looking at Tencent Holdings. That's a Chinese-based company, but they are the primary owner of Fortnite. And it's still a huge craze amongst youth. So it's TCE, Tango Charlie Echo Hotel Yankee. And I guess my last one, I have to kind of keep going in the, I believe where I think the future of the economy is going in the future of business. And I think one of the best companies positioned to take advantage of cloud computing and the growth that comes with mobile is Salesforce, and that's Charlie Romeo Mike. Their quarter, by the way, their last quarterly number, you know, a lot of people have missed numbers and kind of guided lower. They crushed theirs. They absolutely had an awesome quarterly report. They raised guidance. They've sold off like the rest of the market has. So this is one of those companies that I think isn't, you know, you pick it up on weakness. Now, of course, they had a nice $8 move back to the upside today, but this is a stock that was, you know, $160. It's now in the 130s. So those are the ones I'm looking at, on top of Apple and Micron and Disney and Nike and Facebook and E-Trade for that matter. So awesome. Let's couple announcements to wrap it up with before we close our show out for the week. We do have a couple of live events coming up. The first one is next week, a week from today actually. We have a one-day summit in Phoenix, and that is myself, Casey, and Eric, who will be in Phoenix. So I'm actually looking forward to a huge temperature swing. I actually moved to eastern Idaho recently, and our wind chill low on New Year's Day, we had a little Arctic push come down. I know many of you felt it. In fact, Scott Hartman, I've got a joke for you. 95 or 98% of people, when they slide off the road into the ditch, curse. The other 2% live in North Dakota, and they say, "Hold my beer, watch this." Right?
Funny.
Sorry, I know Scott. Scott, I don't know if you're even here listening, Scott, but if you are, I'm sure you appreciate my joke. Anyway, I'm going to enjoy Phoenix next week, by the way, because it was 30 below zero where I was out on New Year's Day. So looking forward to warmth. I'm also going to California a couple weeks after that, to Pasadena for a trade school event. So for those of you who are in either of those two areas, come spend the day with us. They're very educational. You'll get a lot of really good content, and it's great to rub shoulders and meet one another and spend some time with us. Last announcement is our January Trader Workshop. Now, Eric and Jeff, you guys are on tap for it. I'm not sure if you got a date for it yet, or we'll just wait and see still.
We're waiting and seeing still.
Okay.
I just got my schedule. I need to coordinate with the birthday boy.
Okay.
Yeah, we'll figure that out.
Let's wrap it up. Any final thoughts? I'll go around the horn. I'll start with you, Horace.
No, Happy New Year, everybody. And I just want to say I'm really glad to be part of this community. It's been a meaningful part of my life for 7-8 years, and it's a privilege being able to teach. So
we love having you as part of the community.
Thank you.
Charan, I'll go to you next.
Have a great year, everyone. In a couple of months, it'll be my 10th year as a instructor. I'm honored to be part of this community and really passionate about each and every one of you. So reach out if you need help.
Thank you, Char, and we appreciate what you do as well. Eric?
I'm just finishing up my tweet to Bob and Reed, and it's gone. Yeah, it's on to get together. So I do want to say, happy New Year to everybody. Here's to a very prosperous and successful 2019. I feel honored to be part of this community as well. It's been a big part of my life, and I've met some really good people, and it's a special group of people, and I mean that from the bottom of my heart. Those of you that know me know I'm telling the truth. So just pleasure to be part of it with everybody, everybody that works for Options Animal and all of our members, and looking forward to seeing you guys in class and at live events, and let's have a great 2019.
Jeff?
Hard to believe, Greg and everybody, that it's been 15 years as of a month or two that I stumbled across Options Animal U and everybody else, and I want to echo what everybody has said. This is an amazing group. It really is, and it continues to evolve, and it continues to expand, and it continues to amaze me. And as we all push what is known in the world of options, we expand that which is known, and it just gets better and better. And it's because of you, Greg, and Chana, and Eric, and Karen, and Horace, and Scott, and Tony, and everybody that's a part of this community. It's something. I know you've talked about this before, Greg. It wasn't really expected or anticipated that it would turn into this sort of community that it has, but it's really something special and something that I will be forever grateful for. And so as we go forward into next year, everybody know that I, and I'm sure Greg and everybody else, will continue to put everything that we have into it to help everybody that wants to be a part of this to become a better trader. So Happy New Year. God bless everybody. And over to you, boss.
Thanks, everyone. It's a pleasure being with you. I love seeing your success stories. I love hearing comments that we've helped you save money in chaos like this. I love hearing that we've helped you feel more confident in the markets, because that's what we're here to do. We're here to help you. So appreciate being a part of this as well. So thanks, everybody. Happy New Year, and we'll see you all in the Options Animal Weekly, same time, same place next week. Thanks, everybody. Have a good week.